Welcome to the first update of 2020. I'm going to start the year by reviewing what happened in 2019. How did 2019 start? In short, in disarray. The US federal government began the year in shutdown, which lasted for 35 days, the longest shutdown in US government history, and the second in President Trump's presidency. Hong Kong had just become a powder keg as the legislature signed off on a bill which would have allowed extradition to China. The US and China were in something of a pause/stalemate regarding their trade wars as they'd ended 2018 having put on $250 billion worth of tariffs. The UK had voted for Brexit, and then Prime Minister Theresa May was negotiating an exit from the European Union by 31 March. Interest rates were all tipped to go up. Would the US government ever reopen for business? Would Hong Kong and China get sorted? Would the trade war settle down? Would Brexit happen? And would interest rates go up? All in all, a pretty fearful start to 2019. How would investment returns turn out? Well, as it happens, tremendously. 2019 was a very, very good year for investors. New Zealand shares led the way all around the world with a return of 31.6%. International shares, unhedged and hedged to the New Zealand dollar, returned 28.1% and 26.8%. Aussie shares returned 22.6%. Emerging markets were the relative laggards, returning 18.5%. Even New Zealand and international fixed interest delivered returns of over 5% and over 7% respectively, despite a year that began with terrible negative news. 2019 wasn't just a good year, it was the best year for investors since 2009, which was the year following the global financial crisis. A mix of 50% cash and fixed interest and 50% shares would have delivered a return of approximately 15%. That's a great year by anyone's measure. What's interesting is that only 2 out of those 5 stories were resolved by the end of 2019. The US federal government eventually reopened for business, and interest rates, far from increasing, actually fell. But the Hong Kong-China situation remained and remains unresolved. US and China remained and remain somewhat at loggerheads over their trade war. Brexit hadn't happened by the end of 2019, although we can tick that one off the list now, sort of. What does that all mean? So despite this negative news flow that caused fear, logical, reasonable, understandable fear, the year produced exceptional returns. It would have been really easy at the beginning of 2019 to be fearful. Too fearful to invest, too fearful to stay invested. Anyone who responded to that fear by not investing or pulling their investments out would have suffered a financial opportunity cost that hasn't been as high since the end of the global financial crisis. That would have been destructive to their wealth. I can't say that 2020 is going to be as good a year as 2019. It certainly hasn't started that way. But what I can say is that investing in fear or not investing in fear is never a good decision. I hope you found this review of 2019 interesting. I look forward to updating you at the end of the next quarter, and thanks for watching.